Former Obama Treasury Secretary Larry Summers writes in a new op-ed that the Fed is charting a course to stagflation and recession. Okay, I agree with that. I want to make a correction, though. He was Obama's NEC director. He was actually Treasury Secretary under Bill Clinton. Now, joining me to talk about it all, we have Art Laffer, former Reagan economic advisor, Presidential Medal of Freedom recipient, and Scott Minerd, Guggenheim Global Chief Investment Officer. I don't know, Arthur, I go to you. This will not end well. I mean, you had import prices today, another data point, up 11% for the last 12 months. The Fed does this puny 1/4 percentage point, blah, blah, blah. Summers wrote a very good editorial. I don't know if you chaps saw it or not. I actually recommend it to you. I don't think you'd disagree with anything about it. But basically, Art, Summers says stagflation turns into recession. What do you think?
Well, he wrote a great article. And for Larry Summers is a good economist. He may not like us all that much, Larry, but he's a damn good economist, and he's calling the cards straight here. Yeah. And I believe he's right. And what he's basically saying, as far as I can tell, is they need to raise interest rates high enough such that it exceeds inflation by 4 or 5%, which is exactly what Volcker did on January 20th, 1981. The prime interest rate was 21.5%, Larry, and inflation was in the mid-teens, giving us about a 5% real interest rate, which was sufficiently high to bring down inflation over the next year or two. And that's what's needed right now. And Powell is just the worst of the worst, and he's being so cautious, it will end up just the way Larry Summers said. It's unfortunate, but it's true.
You know, Scott Minerd, I know that you from time to time advise the Fed, and that's a good thing, that they should listen to you more. But one of the points that Summers made was that the Fed hasn't really internalized the scope of the problem, that they're still kind of thinking, you remember that old, well, we were undershooting the target, so now we can overshoot the target. Well, they're overshooting the target by like 8 percentage points, and this is in the real world going to be a very difficult proposition to break the back not only of actual inflation, Scott, but of inflation expectations, which I think are more and more embedded into the economy.
Yeah, well, you know, it's interesting, Larry. I was involved in those discussions about this inflation averaging concept, which I found very nebulous. If you want to go with inflation averaging, you know, the debate was always around, well, what averaging over what period? If you go back for the last 10 years, the 8% rate of inflation, we're overshooting the 10-year average at this point. So you're right, and your comment about stagflation, I think, is absolutely right too. And stagflation, as Art well knows, the only way it ultimately ends is to induce a recession, which is what the market now has started pricing for when you look at the shape of the yield curve. So you know, I think that the Fed is totally misguided. I think they're embracing a policy from the 1970s of targeting short-term rates, believing they have some magic idea of where short-term rates should be. And rather than just, you know, let's get back to the business of Paul Volcker, which is we'll manage bank reserves, we'll manage the size of the balance sheet, we'll stop it from growing, and we're going to accept a new higher price level, because we're not going to push the economy into deflation, but let's let the market set the right price and get rid of inflation, rather than
that's the thing.
Policy errors.
Powell, okay, I don't know everything he said today, but Powell in the past, in the recent past, has disdained, you know, the idea of the quantity of money, the size of their portfolio, and all that stuff. He thinks it's something that was 40 years old. And Arthur, one more point that Summers made. There are no rules anymore. In other words, they used to have a 2% inflation rule. All right, now down through the years, you know, we've looked at a commodity price rule. If you looked at a commodity price rule, then the Fed funds rate should be about 10% today or more. Commodities have been soaring. They don't use the Taylor rule. They don't even publish the Taylor rule anymore. The Taylor rule, not that it's exact, but the Taylor rule is 9.5% Fed funds rate. I'm just saying that's how far away they are, 1/4% versus 9.5%. They are rudderless Arthur. So this time people are telling me, well, they were tougher than we thought. Blah, 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 blah. I don't know what that means because there's no rules. There's no benchmark. There's no nothing, Art Laffer.
Well, I think Powell is a PhD economist, or at least he played one in a movie once. I'm just joking, Larry. He doesn't understand this stuff, and it's just ridiculous. And what he's doing is hoping upon hope, which is what they all are doing. It's just, oh, please let it come out. They think it's a random set of events and that there is no model underlying all of this. Larry Summers is pointing that out very clearly. My thought is that the 10-year bond yield should be in somewhere in the range of 14, 13%, something like that. Mm-hmm. Prime interest rate should be very high as well, all to make real rates high so people bring back down. What Scott said is totally correct. You should let these balance sheets roll off and all the government securities roll off and let markets seek their own levels. But these guys are not, and the longer they hold these rates low, the longer they buy mortgage securities, the longer they expand the money supply, the worse it's going to get.
Yeah, Scott, we're running out of time like we always do, but you'll see, Scott, Wall Street, the stock market, no one is in tune. We and Summers, and I reckon Jason Furman, but, people that are monitored, John Cochran, I'm going to put in with our group, they're not listening to us. The Wall Street's not listening to us. The Fed's not listening to us. That's another reason why, Scott, I think it's going to end very unhappily.
Well, Larry, I have a scenario, which is eventually something will give here. And, it'll be a sell-off in the stock market. It'll be something. And the Fed will resort to the old playbook, which is flood the system with liquidity. No. And ultimately, I think we'll be in a worse place than we are today because nobody that I can identify has a clue of what they're doing right now.
Yeah. I hate to sound so pessimistic.
Here.
I just hate to sound so pessimistic. This is a fixable problem. We've learned from the past how can I just on the way out, sound money, strong, reliable king dollar, lower marginal tax rates, deregulation. And right now that would include drill, drill, drill. Arthur, you had it right 40 years ago. You had it right 40 years ago. We're all your followers. They're not listening. And unfortunately, it's the middle class, it's working folks who are going to pay the price from this bloody inflation tax, just like they always do. I got to go. I'm sorry. Scott Minerd, thank you, sir. Appreciate it. Arthur, love, 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 as always.